Hello everyone, my name is Michael Amat. I am the founder of ChartYourTrade.com. Our goal is to inspire millions of hardworking people just like you to take advantage of the stock market. And the way that we're going to do that today is to discuss how to handle earnings, how to hold through earnings, how to buy ahead of earnings, and how to mitigate risk during earnings. So I have two key ways that I like to do it. The first one has a lot to do with position sizing and scaling either into or out of a position, and the other one has to do with trading options around a position that I either have or buying options for a position that I would like to have. So let's pull up some charts and dive right in and explain both of these strategies. So let's use Alibaba as our example. Alibaba is a stock that we've actively traded for our model portfolio in the advanced stock reports. And the model portfolio looks at stocks and trades more on an intermediate to longer term time frame. I have another account, a personal account, that I trade on a shorter term swing trade kind of basis. So we'll look at strategies for both, and let's dive right in. So for the model portfolio, we bought Alibaba right here, right ahead of the earnings announcement. And so one of the things about earnings is that it's one of the most volatile periods of a stock. That's why there's a lot of concern about how do you actually go and trade and mitigate risk around earnings. One of the good things about earnings is that we already know that it's going to be one of the most volatile periods, and so therefore we can plan around it. The way that I like to plan for earnings is to, if I'm going to buy right ahead of earnings, I'm curious, okay, if it does roll over and crap the bed, well, what's the worst that can happen? Where's support, and where is it likely to fall if it does do poorly? So on Alibaba, it was setting up. It was setting up in this very nice cup with handle pattern. It was giving us this advanced entry point, and it actually broke out ahead of earnings, and that's why we bought it. But let's say earnings were terrible. Where could it fall? First stop would be right over here, right below the low of the handle, right? So if we measure the handle, it's about 3.5%, 4% of a handle. So not that much risk there. But let's say it just blows right past that handle. It doesn't catch support. What's the next stop? Next stop is probably going to be the 200-day moving average, maybe the low of that small gap up right there. But let's say the 200-day moving average. If it does gap down to the 200-day moving average, we're looking at more of an 8% loss. So and if it goes further than that, like if it goes back down here, then we're looking at about a 10 to 11% loss. So let's plan ahead and say that if we buy this and it rolls over, we're looking at anywhere from an 8 to 10% loss. All right, so thankfully, Chart Your Trade has a position size calculator that helps us figure out how much we could risk and still just risk this much. So let's take a look at that position size calculator. This is something that I do on every single trade, and it really helps me figure out how much I can risk on any given trade. So let's pull up the position size calculator. And let's say that we have a pretty small account. Let's say that we're working with $10,000 account. Using that for just round numbers, you could have a much larger account, you could have an even smaller account. It works on all these. But let's use $10,000, and we're only going to risk 1% of our trading capital. So if we lose, we're only looking at losing $100. And what was the entry point? It was somewhere around 97.90. So let's put that over here. 97.90, and our stop is going to be right at around 94.80, and if we're using the low of the handle, so 94 480. And let's compute that and see what we get. All right, so we're able to buy 32 shares. It's going to be about a third of our portfolio. And we're risking 3% on the position, and we're risking about $100 if we're doing this. So let's plan for our worst case, since we are doing this right ahead of earnings. So if we were to use the 200-day moving average, the 200-day moving average is at 89.72. So let's put that into the calculator. 89.72. So we recalculate and we see that we're able to buy 12 shares if we buy at 89.72, and we're still risking that same $100. So if we just adjust our position size to where we believe that our worst case scenario is going to be, that allows us to play earnings for any stock we want. We just need to understand how to read charts and understand where support may or may not come in and what our worst case scenario is going to be. So we bought Alibaba and it worked out. Fantastic. Now let's look at the next time it was going to report earnings. And remember, for the model portfolio, it's intermediate to long term, so we're looking to hold Alibaba for the bulk of the move. We ended up making about 80 to 90% on this trade. And so as earnings were approaching, we were still keeping our stop pretty loose at this point. Well, we like to raise our stops up to break even as quickly as possible because the best way to compound our gains, and the way to win in the market is to compound your gains, but the way to compound your gains is to have as small the loss as possible while letting your winners continue to run. So we move our stop to break even, and we move our stop up as support levels build. So a new support level formed over here, then it formed another support level over here when it broke above that resistance level, and again when it was breaking above this resistance level. So we had our stop right around here, right around 110 going into earnings. And so that's allowing for roughly a 15% loss from here, from its peak, to allow it to consolidate going into earnings. Again, it's because we have that intermediate to long-term view that we are willing to take that kind of a drawdown from the peak, versus if we are more shorter term in nature and we want to just quickly lock in gains, then we would go with a different strategy. So I also run a shorter term swing trading account for myself. It's a personal account. And the way that I manage that account is very different. So I like to sell into strength in that account when I start to have multiples of the amount that I've risked. So if I'm only risking 4% here, then I would start to look to take some gains when I have 8% or 12%, and then start to take some more gains off the table when I have 15 to 20%, and then let that last piece continue to run until we get to a very volatile period like we see here. And so I would probably be looking to sell into strength ahead of earnings with that kind of a move, and I probably would end up missing the rest of this, or I would end up looking to get back in on a reversal like this, or potentially trade a very short breakout like this over here, where it was forming this resistance level over here and that breakout there. I didn't actually have this stock in the swing trading account, but I did have it in the intermediate to long-term account, so all this is just kind of thinking about how would I have responded or what would I have done. And honestly, I probably would have sold into strength. And would I have been in there? Maybe not. I tend to keep stocks that are leaders in a separate account so that way I can re-enter them. But if something else would have come onto the radar, maybe I missed this, maybe I don't. So that's how I would do this for the short-term swing account versus the model portfolio intermediate to longer term account. Let's also talk about how we could do some of this with options. So with options, the way that I like to use options right around earnings is that the premium paid, so the amount that you're paying for the option, consider the entire amount at risk. So if we're able to find an option that is $1, that means that if you're paying $1 for a call option, that you're paying $100 for that one call. So if you're able to find that, and for when I'm playing earnings, I typically like to buy calls ahead of earnings. They are at the breakout point or a little bit above the breakout point, and I'll also buy them a few months out, so maybe about 3 to 4 months out, so that way there's a little bit of time value left in them. And so for this over here, it broke out at 97.90. I probably would have bought a 98 or a 99 or maybe even a $100 call option. That would be 3 to 4 months out. So from January, I'd be probably looking at April or May calls. And in this scenario, and if I'm able to find one that was $1, I would only just buy that one because I'm treating the entire premium at risk. So that way, if it does roll over and I lose everything, I'm still just risking that same $100, that same 1%. Now, for me personally, using this strategy, I've yet to see an option go completely to zero. So there's still some kind of time value left in it, even if it's half the value of the call option, or even if it's only 25%, it's still something. Unless if it really, really like falls down to here, then it might be worthless. But if it did fall to the 200-day and it started to get a little bit of support over there, you probably have a little bit of value there, and you would be able to get out with less than your full $100 risk. So that's another reason why I really like to use call options a few months out at the breakout level, because if you're buying an out of the call option that's slightly out of the money, then you're getting it a little bit cheaper, and you're trading with what the expectation is that you're looking to trade. So if it's going to break out, it's going to run. So that's why I like to buy call options that are out of the money, but right around where the breakout is going to happen. And that's how I use options for buying pre-earnings. Now, when I actually have a position and I'm going to use options to help manage that position, this is very rare that I even do this. But if I am looking to protect a position, then I may buy a put at the level where I think that the position could fall to, if I'm going to try to protect that position. So that way, if my core position falls, and this is pretty advanced at this point, right? So let's say I have this, let's say I'm doing this for the model portfolio, and I'm holding longer term, but I'm worried that I'm going to be stopped out of Alibaba. I could buy a put at the level that I think that it's going to fall to, and I would buy right around the 50-day moving average. So at this point, I would buy a $110 put a couple of months out. Again, so that way I still have that time value, and I could buy that put, and then if something like this happens, then I could immediately sell that put after the report, so that way I'm able to lock in that gain and I still have my full position, and I haven't really lost anything. I might have even made a little bit more on that trade because I would have made money on the put, and if Alibaba did fall to the level where I had my my protective sell stop and I get stopped out, then what I lost on selling the stock from up here to down here, I probably would have made that and then some on the put. The downside of that is that if Alibaba runs and does this, then then the amount that I spent on the put is lost. So that's why it's really more of an advanced strategy, and why I tend to use more of the position sizing strategy for my accounts. But different ways to trade, different strategies. There's not really a right or a wrong way to do it. It's just really, well, what are you going to be comfortable with and what works for the different situations. I think that the put strategy could have worked in this particular situation, and the reason why is because I like to look at where is support, and support is way down here. So that's why I like that put strategy over here. In a prior video, I just want to bring this one up, AAOI. I ended up selling right over here, right before it reported earnings. So I bought over here, and I ended up selling into strength over here, and then I sold the last bit of it right up here, right before it reported earnings, just a few minutes before the close. And the reason why is because I thought to myself, okay, let's say earnings is terrible. Where can it fall to? And the answer was that it could fall way down to the 50-day moving average. It could fall way down here, back to, like that. It didn't build support at all, so you're really looking at either the 50-day moving average or the pivot point, which happens to be right down at around the 100-day moving average, and that was a 20%, 23% loss or a 30% loss, and that was something that I was not willing to deal with. So that's why I sold the last bit ahead of earnings. So again, we know that earnings are the most volatile time period, and we need to look at what's our worst case scenario. In this particular trade, the worst case scenario was 25 to 30%. So that's unacceptable. So versus, well, what could be the upside? I was thinking that the upside for this particular one could maybe it runs to 110, maybe it runs to 115. It would typically have a 10 to 15% move after earnings. So potential win of another 10 to 15% versus losing 25, 30%, that didn't make sense for me to stay with that trade. So that's why I opted to exit on AAOI, and I ended up avoiding that mess there. So that's how I manage my positions around earnings. That's how I buy ahead of earnings, and that's how I initiate some of my sell strategies around earnings as well. I hope you found that helpful. If you have any questions at all, please leave them in the comment section below. I know that that's a little bit of a complicated topic, so I'll be happy to help you out further if you do have questions. If you liked the video, if you got something out of it, click that little thumbs up button. That really helps us out a lot. And also make sure that you're subscribing to the channel so that way you get all these updates. Thanks so much for watching. I truly appreciate it. I truly appreciate your attention. And thank you so much. I'll see you again in the next video. Take care and have a great day.